So, financial modeling techniques, there are many things that we teach and we should know as a financial analyst. And one of the commonly used way of forecasting the working capital, there are three main line items in the working capital, right? So, we have the receivables, inventory, and the payables. So all of these three have to be forecasted, and we often use the days methodology, particularly if you are a beginner or if it is a plain vanilla company. This is a good enough methodology to be used to forecast. So how do we go about this one? To look at the days methodology, let's look at the example of days sales outstanding. So to calculate the days sales outstanding, you will look at your average receivables in a year, and let's assume for this company it's $100 million and your revenue for the year was $1 billion. So what in essence means that you are able to get 10 times of the receivables as your sales, or you're able to do the receivables in 1/10 of the time for in a year. So if I divide the receivables by the sales, I'm getting 10%, and if I multiply that by the number of days in a year, so this could be 365, or you might use slightly lesser adjusted for holidays, but let's say you're using 365, that means you are having 36.5 days worth of receivables as compared to the sales. So we can then apply, if this is kind of constant or we expect it to be constant for that company, we can then apply this to forecast future receivables. If I have projected my revenues, revenues projection is obviously a challenging one. We need to figure out the product mix, the growth in product sales, the price change, a lot of that. But let's say we have done all of that and we want to assume that the receivables as a percentage of revenue is going to be constant, then I can use that 36.5 days and multiply with the revenue that I have forecasted for the future and divide it by 365 to get the receivables for my forecast period. So the same thing we can do with inventory as well as payables. So I think for inventory you can use cost of goods sold. Primarily I think that's on the raw material side, and use that to calculate your inventory or forecast your inventory rather. And the same thing on the payables, you can again use your purchases or your cost of goods sold and calculate the future forecasted payable values as a percentage of your purchases. So we're going to jump into Excel. We're going to look at a model. I think this is a steel company, Indian steel manufacturer. We're going to see how we can calculate the DIO, the days inventory outstanding, DSO, DPO, and use that to forecast for the future. All right, so this is a model that some of the financial modeling students are working on. So this is also a good way for us to check if they have done a good job with their days methodology. So as I said, I think this is a steel firm that they're working on. I think they're not using the full consolidated statement, but the standalone, but still for understanding the technique, that's still okay. So we can see in the assumptions sheet, balance sheet assumptions, we have DSO, DIO, and DPO. So these are, I think, the historical till 23, and then from 24 we are projecting. Let's look at, as I said, we'll take one of these. We will take the days payable outstanding. So the days payable outstanding, as we can see, it's 105 in 2023. Basically, the way we are calculating that is your trade payable divided by your cost of goods sold. So if I go to my historical P&L for 2023, I have my raw materials, cost of goods sold. So let's make sure. So it's 0.29 or 29%. And then to this, we need to multiply the number of days. So I think the students are using 360. They're assuming some holidays. Okay, doesn't matter. Go with 365 or 360. So if I'm using 365, so it's fine. So that's how they are getting the number of days. Once they have that, then they can take a call whether that's going to change. And as I said, this could be based on what you hear from the management, or you have done some analysis and you expect things to be different next year or the year after or in the future, then you might tweak it. So here, the students have assumed that it is going to be constant. So that's a simple assumption and simplifying assumption. So once you have made the projection in terms of days payable outstanding, then you can project your trade payable or your accounts payable if you have already done your cost of goods sold, or particularly the purchases, the raw materials as such. So here, what we are going to be doing is multiplying. So to get to that 15,640, you're going to be multiplying this with the raw material for 2024, which would be that, and dividing it by 365, right? So I think they are using 360. As I said, I saw some of them use 360. So that's fine. So that's the technique you'll be using to project the working capital line items. Very important concept. And once you have this, you can tweak this, and definitely you should tweak it. And we in our classes definitely give some guidance. But the more you work on a model, the more you understand a particular company, then you will realize that you can't just keep it flat, and you need to make some informed assumptions and decisions. Okay. So as you can see, this is a very handy technique and it is very useful. In some instances, we have to make adjustments to these techniques, and these are often the requirement. If you are an equity research analyst, you will often have to adjust some of these based on what you hear from the management or what you see in the economy. And those things is what makes you a great financial analyst. I hope you found this video helpful. If you need more information or you have any questions, just leave a comment below. We'll be happy to assist. All the very best in your financial career. Bye.